Okay, I've got the recording going. Let's just backtrack just a little bit. I got a little bit ahead of myself. Welcome to the Hurley Investments Financial Services Midweek commentary on Tuesday, June 23rd of 2015. I made the quick comment that the commentary I heard today from CNBC is you don't know there's a market problem until there's a problem. I asked what we've been waiting for the last 4.5 years. The comment was made. Higher interest rates, the dreaded correction, which is a 10% drop or more, right? We're talking about a full-blown correction, which happens, what, every year and a half or so? 10% plus drop. And then the pig's drama to end or to get kicked out of the euro. So now that we're recording, we'll jump on. My last question was, does it matter to the stock market? And I've got Abraham on one today. Mod says apparently not. Daniel says no. It should because influence on the dollar. Bert, great comment. Dollar was up today. Let me show you a little chart though on what I was looking at. Dow Jones. I'm going to bring this back. Come on, come on, come on, come on, come on, come on. Going to try to bring this back. There we go. Okay, I'm going to bring this back to 10 years. Although I should do 5. Let's go ahead and let's do 5 years. But I kind of need the 10 years to show you. So, we started with this money flow, right? We had the 2008 correction. We started with Q1, and taking a look at our chart from literally, let's take 2009 till today. Does it matter? Now, we've said apparently not, or no, it doesn't. I'm going to go and I'm going to tell you, in my opinion, it does matter. It does matter. It is extremely important. But what has made all of this drama not matter? What has made all of this drama not matter? The Fed's easy money. You know, there you guys go. QE to infinity, right? $4.4 trillion has made it not matter. Now, Daniel made an interesting comment. He just said short-term sightedness. I will be the first one to say that all the money in the system scares me. Because to truly make it not matter, we literally have to be in some of the bonds or notes. Well, the bonds for like, what, 30 years? The notes for up to 10. So at some point, we have kicked the can down the road. But I'll be the first one to tell you, I'm not sure I was prepared or ready for a financial crash of the banking or the financial markets in the U.S. I feel I would not be ready for a Great Depression because that would put me out of work. I think we should have felt some more pain in the ridiculousness that the banks went through. But I think literally the Fed made it so, for the most part, other than Bear Stearns, The economy as a whole didn't feel the pain that was needed, quote unquote, to rectify the situation that we were in. With all of that said, that is just my opinion. I don't know how I would have handled anything different other than taking some of the pain now. In all honesty, I still think the everyday person, the middle America, is gypped in the end to a certain degree. Yes, we get to refinance our home at a lower interest rate, but there's still higher unemployment than there was in 2007, 2008. There still isn't the strength in the dollar. A dollar buys less today than it did back then. We haven't seen the increase in the earnings as we expect to. So I guess I don't feel I'm smart enough to understand how to get us through a Great Depression. But I do know that there were some things done wrong. How does that say? Any comments? Any comments you guys have along these lines of thinking? Any comments you guys have along these lines of thinking? As soon as the Fed raises interest rates, there'll be a lot of fearful selling. Bert, I agree. But I'm pushing my September call of raising rates since Greece is going to have to make another payment in September. I am pushing my Fed raising the interest rates out to January or March of next year. I don't see it happening in October when the Fed's not speaking. I also don't see it happening in December. I think the Fed is very fearful of creating a 1937 relapse or restart of the Great Depression. So I think in their mind, based on past history, they are more likely to push things out to the future and give the economy a stronger, how'd you say it? To give the economy stronger footing than to just fire away and let things start going to hell in a handbasket. The bailout may have been bad. Well, I agree. The bailout, well, I guess the bailout to a certain degree has worked, but I'm not sure I see any changes in the rules regulations to the big banks that taught them anything. Now, I know there have been some ridiculous fines, but I guess those fines are somewhat minuscule to the amount of money these sons of a guns bring in. And they're astronomical. For us to understand them, you and I don't understand a $1 billion fine. We just, our brains don't comprehend those type of numbers because we don't have those type of numbers. I do not think there will be a depression, but there may be a correction. This is another one that I don't know. If you mathematically work the numbers out, those numbers, man, it's scary. If you mathematically work out those numbers, we should be in a bear market upwards to about 40%, because about 40% of the current growth of GDP, of the stock market, of the money in the stock market, et cetera, can be directly traced back to the Fed. So once again, don't understand, don't know, can't explain it, but I do know we will have to pay the piper at some point. I unfortunately, Daniel, do not see a correction later on this year. I think our correction will come next year, and our correction, if it wants to take the pain, will most likely be a bear market scenario that could drop our market as much as 40% mathematically. That does not mean that I think it will happen. It would not surprise me to see the Fed start more QE, in all honesty, which again is somewhat ridiculous. But again, what I'm telling you is that I really don't know. And because I really don't know, I'm now to the point where I'm more likely to get some protection on sooner than later, and or I'm more likely looking to start to, I don't know, I guess I would start to feel like I need to protect at these FOMC meetings. Collar trading, correct. What would make the Fed do more QE, Mod? Yellen hasn't gotten to really do QE yet. She's just taken over what's been there, and a fearful drop in the economy, a recession. There's a lot that could cause, well, there's a lot that gives the Fed an opportunity to come and save the day again, so to speak. All right, with that said, bring me up to speed. What's happening so far this week? What is happening so far this week? I'm trying to make you guys think so you can start to trade for yourself. Straight as an arrow. Up, right? Except for today. What's happening this week? Greek drama. Monday, Greece blinked and is willing to negotiate terms. So our market shot up, right? Seems to be resolving their problem. On the U.S. side, existing home sales came in at 5.35 million versus an estimated 5.26 million. With that also, new home sales came in at 546 versus an estimated of 525. So it moved, you know, for lack of a better term, home sales is improving, and home sales is still the America's primary retirement machine. On the flip side, durable goods came in at negative 2.0 versus an estimated negative 0.5. And durable X transportation, though, came in at a negative 0.3 versus an estimated a negative 0.3. I'm going to go back because someone just made a comment. I have 6 years left until retiring. The secret to making money in 2008, and I'm not going to say it was simple because it wasn't, but I'm going to pick a stock. I'm going to use Apple as one. Boy, that's not a really good looking chart of Apple. Because everything's up, huh? Let me go out for a year and a half. All right. You know what? I'm going to make it even simpler. Let's just go out a year chart on Apple. What saved me in 2008 was nothing more than levels of support and resistance. What I mean by that was I had a collar trade on Apple, and right now we seem to have some type of support at 125. So as things started to fall, I collared up Apple and down it went. Where's your next level of support on Apple? Looking at your chart, where's your next level of support on Apple? You could say 120. Now, I would have missed that one. In all honesty, only $5 drop, I would have missed that one. Where's your next level of support on Apple? Okay. Yeah, there's definitely one at 112.5. I can also make a claim that there's one on the gap, which seems closer to 115. It's probably around 114. So when things were going ridiculous, I know I had a long put on at 125. I would not have got the 120, but I would have added a second long put contract at 115. And then literally, I would have one sitting there ready to put into place at that 105. As things fell and fell so hard and so fast, I just kept adding long put contracts at areas where there was support, and literally the stock was falling so quickly, it would come down, bounce and test it, and then 4 days later, it seemed to go down. If we were in today's stock market and things started to happen, yes, I'd go out to August and I would just start to layer up these long puts on the way down. That is how I made it through 2008. Anyone with me 2008, we made somewhere between 8 to 18%. And yes, Maud, I just set up a bunch of orders that if Apple traded below 105, it would trigger a long put for me. I didn't do any more than 3. I didn't do any more than 3 because I didn't have the money to do any more than 3. I didn't do any more 3 because I went into some margin in my account to buy these positions. It's how I made it through 2008. And if I can take you back really quickly, and I want to use Apple. At the time, Apple was at 205. And boy, that just is not a good chart because they did their split. But literally, Apple was up here at 205 at the time. It since has split. And I remember protecting Apple at 200 for an earnings event. And they didn't have good earnings and they fell hard. So I then went to 180 and then a 165 were the levels of support at the time. I did not have, nor do I think anyone had experience in 2008. And And the reality is, so much was falling so fast there because Ma just made the comment. Did you experience any of the bear bounces, or I'm going to say a dead cat bounce, right? Which could be huge bounces up. For Apple, I did not, but for some of my other stocks, I did. And the short answer is, Maud, I kept my stuff in play trying to go from earnings to earnings. And the stock market was horrible. The stock market felt like there was no tomorrow. I don't know when we're going to see another fall. But we know there's one out there because our market has been propped up. What a horrific fall, literally from 1600 down to, 765, I believe. Here are a couple points that I'm going to make out, or that I want to make out for today. You don't have to catch the initial drop. I can't spell. Initial drop in the correction to be profitable for the year. So don't think that you've got to nail it. Oh, the correction's coming, you got to throw everything on there. You don't have to catch the initial drop. Will your account be down? Yes. But will it be down for forever? No. In 2008, I was not profitable till the last half of the year. And the reason why is because I was able to make up some of that downward movement, and then I bought into stocks. And Apple went from 205 down to 135, back up to 165, back down to 88. It was those type of movements where I didn't time it perfectly, but when you start to see things come down, you see them drop through levels of support, you throw on a second layer of long puts, and you're going to be in pretty good shape. You have to be on your toes. Right now, you have to be on your toes. But one of the comments that I am seeing over and over and over again, why, and I think it was Daniel that said, when you see interest rates rising, you will see some panic selling from retail money, is because a lot of people are very fearful or have been outright decimated by 2008. So the short answer is, use it to your advantage. The more you can make up on the drop on the way down and convert into more shares, you're dollar cost averaging for the bounce up the road. Look at trading as a process. So remember, you don't have to catch the initial correction to be profitable for the year. Look at trading like a process, not a one-time event. With that said, I want to bring up a couple things that some of you might go, Kevin, that's a one-time event. Not true, not true, not true. So let me get this up and going here. I want to stick a picture in here. Someone asked me the other day, well, Kevin, would you, roll out a spread trade? And I would not roll out a spread trade, which is obviously going against the way that I want it to go, hoping that somewhere down the road it's going to be become better. What I mean by that, I'm going to bring SanDisk in here. So someone asked if I would roll a spread trade out in time for lack of a better term, I'm going to quote it, hoping for the strategy to become profitable. And my answer is no way. No way, Jose, right? In spread trading, you are playing a shorter term trend. So I want to follow the current trend, right? I want to play a trend. I don't want to roll something out hoping. Now I'm going to make the comment. Now investing is different because you want to buy and hold, and I'm going to put in there in parentheses, while collar trading, right? To book profits as long-term capital gains. With that said, I brought in here a SanDisk trade. Let's look at the bottom first. Is that big enough that you guys can see? You guys okay? You able to see that one? Okay. It's funny because I get people all the time to say, but Kevin, you said this, but you did that. Not true. Not true, not true, not true. I sold some SanDisk puts way back on the 15th for $2.13. I bought them back for 82 cents, which means I booked a profit of what? Yeah, I need to go to my calculator too. $2.13 minus 0.82, booked a profit of $1.31. Looked like SanDisk was going to go up to 70. Didn't quite make it. That was May, so my next step was to sell the June 170 puts for $1.71 credit. Now, it's not working the way I want it to, right? Obviously, or I wouldn't still be here. Would have taken my profits and run. Pretty tight range for SanDisk. Big drop in earnings. It's definitely undervalued right now. But I've got a 50-day, I've got a 100-day, I have a 200-day simple moving average to break. Now, I've done my fundamental research. Their pricing on DRAM is going down, but with the introduction of Windows 10, you usually get a spike in some computer sales. So they should be okay towards the end of the year. Should be okay. Quote unquote, right? Well, it's an ugly chart, but it's sideways. It is sideways moving. The key is I probably should be starting these shorts closer to here at 62.50. But I got caught. Stock came all the way up here in June. It headed down that way. looking back at my short puts, since I have a short put at strike 70, what should I be willing to do? What should I be willing to do if I have a short put at strike 70? There you go. I should be willing to buy the stock. And in this particular account, I am more than willing to buy the stock. More than willing to buy the stock. With that said, right now, I've only got a $1.31. I had to take this credit, right? Bought it back for $4. So in this case, that part of the trade, yeah, not one of my better ones. $4 minus 1.73 means I'm now down $2.27. But I now have a new credit where I'm taking in $4.78. Notice how, for the most part, since I'm now stuck in this, I'm going to keep the same 70 strike price. What am I doing? Where am I at? What am I doing here? I'm just trying to have my SanDisk short puts expire worthless. That's all I'm trying to do. Rule number one, am I going to let these short puts go into the week of options expiration? Not if I want to be profitable. If I'm at fear of getting called out, I'm going to be losing money. Before this gets into the week of options expiration in July, I'm going to roll them out to an August 70. I really don't care if it's down at $60 a share at that point. Because if it's at 60, I'm going to get roughly $12 of credit for my Augusts. I can play the roll game for forever. And if I get called out early on August at $12 on my 70 strike long puts, what would my actual cost basis be? Well, you've got to add this all up together, but it's going to be awfully close to $60 a share. I've got caught in short puts, and I want to take that stock ownership. In all reality, when I'm pretty close to break even somewhere at the bottom, so I can have the stock run back up. Correct, Daniel. I'm selling a short put. Sometimes I get to buy it back for a profit. Sometimes I'm buying it back for a loss. But if I'm down 227 in this portion, I'm going to take a much bigger credit up here to make up for it. Does this happen all the time? Nope. Doesn't happen all the time. But in positions that I have been in for the last couple months, I'll be honest with you, it has happened to me twice. This one is a little bit different on Alibaba. This is one that I can take the stock ownership in, but if I did, I would then be dollar cost averaging other shares, and I need to sell some off. This one is a little bit different because I have 118. 118, and these are part of a collar trade, and basically what I have a collar trade where I've got some long puts in place, right? So those long puts, I need to make sure that that I play with them, that I can work with them. Plain and simple, I have June 191s. Well, for crying out loud, those suckers were not helping me. That's the best way to say it. They were not helping me. I had to be a little bit different. So in this particular case, yes, I've got some long calls against stock ownership. I had some long puts expire, worthless. So I'm basically playing with my 91s. Well, to buy them back, what I sold for 118, I had to buy back for 525. So if I do my math on those two, right? 525 minus the $1.18, that puts me upside down by $4.07. I need at least $4.07 in my credit to make this worthwhile. Well, I sold some for $4.91, sold some for $4.91. I also got to go down. Not only am I covering this loss, I am picking up, this is a 7 by the way, I am picking up 84 cents of extra credit. I'm also down $1 now, where I only have to buy it at 90, no longer at 91. I am just playing the roll game here, so that if I get to take in this whole big credit, well, on this one, the reality is I don't want to take the stock ownership, so I'm stuck in a bind, and I'm rolling this until I don't get called out, which is a little difficult. It takes a huge amount of margin because I do not have the long puts covering it. Can I afford to take the stock ownership? Maybe I should just collar this part? Maybe. Maybe. But the neat part about these short puts, I can roll them out. There was one time I rolled short puts out on BlackBerry, on RIM at the time, it was RIM, all the way out for 13 months. And it was amazing. If I continue to roll this for 13 months, taking a quick peek at the screen, right now we're just talking in terms of dollars of, 981 plus this. So we're talking about a net of about 2,500 bucks. How big do you think my credit was with rolling out RIM for 13 months? Just out of curiosity. How big do you think that credit was on RIM, rolling it out 13 months in time? 1,500 from Bert. Think much higher. Think much higher. 5,000. Think much higher. 10K. Go higher, please. 13 months, and I should be honest with you, 20 contracts. 20 contracts. Go higher. 100K is a little too high. It literally was a $74,600 credit as RIM went down from 135 down to like 60 and then back up a little bit. Guess what? Eventually I got to sign those shares. And the next day I sold those shares, and on 20 contracts for 13 months, I made roughly a whopping 5,100 bucks of profit. Short puts, Daniel, short puts. Are there better ways around tying up that much capital? Yes. Most definitely there are better ways of tying up that much capital. But your saving grace on short puts is they're not as actively traded as short calls. So you can play the roll game for forever. This is why I am more anxious or more likely to short puts against long puts as an adjustment to the caller trade. And it just so happens with the last couple weeks, last month, I think it's a ridiculously hard month to trade in, but it's been a pretty easy month to sit in caller trades with. Advice to you guys, don't hesitate to caller. Caller trading is a great way to be able to sit through some of these events. World market end this week. I'm going to say higher still because we have a Greek resolution next Monday, and next week is also a holiday, shortened week with Friday having the markets closed. Fourth of July, money sign of July. That's kind of funny. 4th of July. So I think this is about Greece. Only reason why I think we're going to see that is because as you look at a chart on the Dow, and because we had a spike in the dollar today, but it was not sustainable, at this time, I just don't see a whole lot of threats. Technically speaking, our Dow is slightly profitable and slightly profitable, slightly bullish. And it does have all three crossovers. Someone asked me the other day, Kevin, why don't you use the 5 and the 20? I usually don't use the 5 and the 20 because I want to see what, well, let me take that back. I usually do use the 5 and the 20, but I always start off with my indexes and I want to look at what big money looks at. And big money does not look at a 5 and a 20-day moving average. They look at a 50, a 100, and a 200 simple moving average. I've never heard anyone talk to me about honestly using in the big money world a 100-day simple moving average. Yet, as I see some of these bounces, it's being used in some fashion or form because we're getting some bounces right at some 100-day simple moving averages. So I always bring out my indexes because they're not a stock. I will not look at an index on a 5 and a 20. I'm looking at it big picture, and I'm looking at it as big money would look at it, which tells me, hey, 50-day, 100-day, and the 200-day simple moving averages. So we're bullish there. If I bring in the SPY, we're going to see much of the same thing. Someone also asked me, Kevin, you should follow the rut. I'm sorry, the rut is not, I don't want to say not important, but the rut lacks any weight to market movement. It is the small caps, not something that I would be trading off of, but I would trade it for the first quarter where historically it runs 7-8%. It's a good buy and hold for a first quarter. And then obviously we have the index that's outperforming most of the others, the Qs. And it also very bullish, holding the 50 for the most part. So when I take a look at these type of positions as I go down with options expiration, I have stocks sitting alone, expecting a buying opportunity because of Greece. Stocks I have sitting alone right now. Ford, Nvidia, Disney, Visa, Facebook, Walgreens Boot Alliance. With that said, I have Baidu, Apple, and I'm going to put a half next to Apple. Colored through August. What else could I have? Thinking. Yeah, that's about the majority of the portfolio that I have right now. So, I still think June is going to be up 2%. And we have a question that came in. If you sell short puts against long puts, it's hard to gain profit if the stock goes down below the short puts. You're losing money on the short puts, but making money on the long puts, but not getting much because of the loss of your short puts. So here, again, the comment I made there, Daniel, is I short puts against my long puts in my collar trade. And obviously, I'm going to add some short puts when the stock has gone up. I am getting, I guess I'm getting stung on SanDisk because it had that unexpected drop. I'm getting stung on Alibaba because it also had an unexpected drop after good earnings. On the flip side, my short puts have worked out really good for Apple, for Disney, for Visa, for Ford, for Nvidia, for Walgreens. Shorting puts against long puts within your collar trade will kill you if it's a bearish movement. So don't have short puts on if you have a bearish stock. But if you have a good earnings event, you typically will have some type of base, a floor, a support level, a gap that you can use. So at that point, you obviously, Abraham, thanks for being here. At that point, if you have that gap, that support, a base that's built, those are good points to short some puts to get your money back for the long puts. Disney last quarter, I did a 110, 105 bear put. First time I can ever remember that I did a bear put strategy on Disney. It worked out pretty well for me. Cost me $1 and change, low change, like $1.20 to protect Disney, and it's now trading upwards to what, 113, almost 114. Good question. So I've stuck with the 2% up for the month. It looks like we might be awfully darn close to that as I get back up to the S&P. Not a big month here, but 2110 to maybe move it up to 2150. I think Greece will be the catalyst that'll move it up to that 2150 for our 2% return in June. Not a whole lot's going on. We have Darden restaurants today and Carnival. Tomorrow we have some home guys with HB Fuller or KB Fuller and Lennar. Thursday, Nike's the big one. I still follow Winnebago and Barnes & Noble. Economic reports, big one tomorrow, GDP. Out of curiosity, what do you think GDP is going to be like? What do you think the GDP is going to be like? I've kind of been flipping through my, just so you know, the GDP is estimated to come in tomorrow at a negative 0.2. A negative 0.2. Leading indicators was 0.7 last Thursday versus a 0.4, which means growth in the economy. Housing starts was in line, building permits was in line. Retail sales 2 weeks ago was a little bit better than expected. Auto sales were better than expected. Wholesale inventories better than expected. I'll be the first one to say I don't know either. But it would not surprise me based on other economic reports that we see GDP flat or a positive number versus a negative number. Tomorrow will be a pretty important day, and the GDP number normally comes out before, you normally will see that before the market opens, I believe. Let's make sure I'm correct there and giving you guys good information. Kevin, you told me it would be, so we have GDP that comes out at 8:30. That's about an hour before the market opens Eastern Standard Time. And Mod, yes, they are recalculating GDP. They're now using GDP for the sale of tangible items, such as tangible and quote unquote intangible items. So now artwork that's being purchased counts as GDP. Patents and so forth, whether they're producing income or not, are now counted towards GDP. So yes, the way they're calculating GDP now, it's in the favor to have better than expected GDP, which is garbage. Internationally, not a whole lot comes out through the rest of the week. Japan industrial production on Sunday will most likely create or move our futures on Monday. But again, it is a holiday shortened week. With that holiday shortened week next week, I will not be around on Tuesday. And unfortunately, Greece will probably move us higher. The big difference is on Thursday, there'll be no big money in the market, so to speak. But we have our average work week, which means our non-farm payroll or private payroll. As long as they're looking at the non-farm or the employment numbers, obviously they're going to be a little bit higher because they're seasonally boosted through summer. More people are looking through work at that time. I'm going on vacation. I did scouts. So I was with the scout troop last week. Kind of funny to see a scout leader on their computer during the day occasionally, but next week I'm going to enjoy the holidays. Any questions that you guys have? Any questions I can answer for you guys? Thank you, Daniel. If there are no questions, let's call it a night. I think you guys should all have a good vacation as well. Thank you, Maud. Enjoy your vacation. Have fun. Thank you, Bert. Appreciate it, guys. All right, hey, let's call it a night. I will get this information posted on Hurley Investments, my Hurley Investments. I'll get that out there for you. Guys, enjoy the market while you can. I know it's a June gloom, or we're kind of facing a ridiculous market. As I look, I think it's been definitely pretty difficult market this year. Really hasn't moved. Yet you heard about all these new highs, new highs, new highs. I mean, for crying out loud, our market really hasn't moved. Yeah, it opened up down here, but the reality is just earlier it was at 18,100, 4 days before the market closed. We're at 18,144. I honestly see the market basically being up 44 points, minus, obviously, the last 4 days of last year. All that volatility in there, little difficult to trade in. Callers are the way to go. I love callers just to shorten things off, make things quieter. I believe it was 268. 268 is where we ended the year. But again, I saw us at 294, only at 21.24. We're really only talking 34 points. So awfully difficult year, awfully volatile, for lack of a better term. We've literally gone through 6 months basically sideways. Guys, take care. Appreciate your time. Look forward to seeing you in 2 weeks, and enjoy your 4th of July, everyone. Bye-bye.